Hello guys, welcome to my YouTube channel. Today I am going to explain some important problems of marginal costing. Okay guys, now see the 12th problem. The following data is given. Fixed expenses is 10 lakhs, variable expenses is rupees 10 per unit and selling price is rupees 15 per unit. Indicate the number of units to be manufactured and sold to break even to earn a profit of 10,000. What additional units would be necessary to increase the above profit by 5,000? So now we have to find the break even point, and to earn a profit of 10,000 we should find the number of units and what additional units would be necessary to increase the above profit by 5,000. So when we find out the profit, then we have to find out the additional units which is going to be increased for the above profit by 5,000. So now let's see the problem. Given fixed cost is 10 lakhs, selling price per unit is 15 per unit, variable cost per unit is 10 per unit. So according to the given information, we should find BEP. So in the question, they said that selling price per unit is 15 and variable cost per unit is 10. So they have given selling price and variable cost in units. So we need to find BEP in units. So BEP in units is equal to fixed cost by contribution per unit. So contribution per unit we have to calculate, that is contribution per unit is equal to selling price minus variable cost. So apply the values in the formula. So we will get 15 minus 10, that is equal to 5. Now apply the contribution per unit in the BEP formula. BEP is equal to 10 lakhs divided by 5, that is equal to 2 lakhs. Now we have to find second question, that is required units to earn desired profit. So we have a formula for it, that is equal to fixed cost plus desired profit divided by contribution per unit. So fixed cost is 10 lakhs and the desired profit is 10,000. By adding these two we will get 10 lakhs 10,000 and the contribution per unit is 5. So 10 lakhs 10,000 plus divided by 5 we will get 2 lakh 2,000. Now we have to find the third question, that is additional units would be necessary to increase the above profit by 5,000. The above profit means the desired profit by 5,000 we should increase. So we have to find the additional units for increasing. So number of units required to sold to earn a desired profit of rupees 15,000. So how this 15,000 came means desired profit, that is 10,000 plus this in the question he asked to increase about profit by 5,000, no? So we will add 10,000 plus 5,000, so we will get 15,000. So now we have to apply the formula which we have applied in the second one, that is fixed cost plus desired profit divided by contribution per unit. Now apply the values in the formula and after substituting we will get 2,03,000. So for increasing the above profit by 5,000, the number of additional units to be sold, that is additional units minus desired profit, that is equal to 2,03,000 minus 2,02,000. So we will get 1,000. So that is the additional units. So now let's see the 13th problem. From the following data, calculate the break-even point. So given selling price per unit is rupees 20, direct material cost per unit is rupees 8, direct labor cost per unit is rupees 2, direct expenses per unit is rupees 2, variable overhead per unit is rupees 3, fixed overhead total is rupees 20,000. If sales are 20% above break-even point, determine the net profit. So now we have to find out the break-even point and the net profit. So now let's see the problem. So given selling price per unit is 20 and the variable cost we have to find it. And how to find variable cost per unit is add the given direct material, direct labor and direct expense. After adding we will get 15. So that is the variable cost per unit, and the given fixed overhead is 20,000 and the sales is 20% above break-even point, that we have to find out. First we have to find out break-even point. So here we use break-even point in units because selling price is given in units. So break-even point in units is equal to fixed cost by contribution per unit. So now we have to calculate contribution per unit. Contribution per unit is equal to selling price minus variable cost. So selling price is 20 and the variable cost is 15, which we have calculated. So 20 minus 15, we will get 5. So apply it in the break-even formula. Break-even point is in units is equal to 20,000 divided by 5. So we will get 4,000. So now we have to calculate the sales. So therefore sales is equal to break-even point plus 20%. So break-even point is 4,000. So 4,000 plus 20%, we will get 4,800 units. That is sales. Now we have to calculate profit. So profit formula is equal to sales minus variable cost minus fixed cost. First take down the given sales, that is 4,800, and multiply it with the selling price per unit. So 4,800 into 20 minus 4,800 into 15, and this 15 is the variable cost per unit. So 4,800 into 15 minus 20,000. So 4,800 into 20 is 96,000. 4,800 into 15 is 72,000, and minus 20,000. So by substituting these values, we will get 4,000. So now let's see the 15th problem. From the following information, calculate the break-even point and the turnover required to earn a profit of rupees 36,000. So given information is fixed overhead is 1,80,000, variable cost per unit is 2 rupees, selling price is 20 rupees. If the company is earning a profit of rupees 36,000, express the margin of safety available to it. So now we have to calculate the BEP and the turnover to a desired profit and the margin of safety. So now let's see the problem. So given fixed cost is 1,80,000, variable cost per unit is 2 rupees, selling price per unit is 20 rupees. So first we need to find out BEP. So BEP in units, why in units? Because selling price is given in units and variable cost also given in units. So BEP in units is equal to fixed cost by contribution per unit. So contribution in units is equal to selling price per unit minus variable cost per unit. So substitute the values. So 20 minus 2, we will get 18. So that is contribution per unit. Now we have to calculate BEP. That means we have to substitute the values. So 1,80,000 divided by 18. So we will get 10,000. So the second one, expected sales is equal to fixed cost plus desired profit by PV ratio. So PV ratio, we need to find out. PV ratio is equal to contribution by sales into 100. As we know, contribution is 18. So 18 divided by sales, that is 20 into 100. 18 divided by 20 into 100, we will get 90%. Now substitute the values in the formula. So expected sales is equal to 1,80,000 plus 36,000 divided by 90%. So after substitution, we will get 2,40,000. So now the third question, that is margin of safety. So margin of safety formula is profit divided by PV ratio. So 36,000 is the profit and the 90% is PV ratio. So 36,000 divided by 90%, we will get 40,000. So now let's see the 16th problem. You are given the following data for the year 1978 of X company. So variable cost is 6,60%, fixed cost 3,30%, net profit 1,10%. So the total is 1,00,000 and 100%. So find out break-even point, P by V ratio and margin of safety ratio. So we need to find out break-even point, P by V ratio and margin of safety ratio. So now let's see the problem. So given variable cost is 6 lakhs, fixed cost is 3 lakhs and the net profit is 1 lakh. So first we need to find BEP. So BEP is equal to fixed cost by P by V ratio. So P by V ratio is equal to contribution by sales into 100. So we need to calculate contribution. So contribution is equal to sales minus variable cost. As we don't know sales, first we should calculate sales. So sales is equal to profit plus variable cost plus fixed cost. So now apply them in the formula. Apply those values in the formula. So profit 1 lakh plus variable cost is 6 lakhs plus fixed cost 3 lakhs. So by adding this, we will get 10 lakhs. Now calculate contribution. So contribution is equal to sales minus variable cost. So sales is 10 lakhs and the variable cost is 6 lakhs. So 10 lakhs minus 6 lakhs, we will get 4 lakhs. So now we have to calculate P by V ratio. So P by V ratio is equal to contribution by sales into 100. So contribution is 4 lakhs and the sales is 10 lakhs. So 4 lakhs divided by 10 lakhs into 100 is equal to 40%. So now calculate BEP. So BEP is equal to fixed cost by P by V ratio. So fixed cost is 3 lakhs and the P by V ratio is 40%. So 3 lakhs divided by 40% is equal to 7 lakhs 50,000. So now we have to calculate MOS, that is margin of safety. So formula of margin of safety is profit by PV ratio. So the profit is 1 lakh and the P by V ratio is 40%. So 1 lakh divided by 40% we will get 2 lakh 50,000. So again we have to calculate MOS ratio, that is margin of safety ratio. So margin of safety ratio is equal to margin of safety divided by sales into 100. So margin of safety is 2,50,000 and the sales is 10 lakhs. So 2,50,000 divided by 10 lakhs into 100 is equal to 25%. So guys, today's session is over. As I said you in the previous video, today I am going to wind up this unit. So I will provide all problems in the description by providing link, and I will even provide questions of all the problems. So if you like my video, please subscribe and share it to your friends, and thanks for watching my video and have a nice day.